So any questions you have at any point in time, please feel free to ask as I go on in this course. Okay, so let me go on. Let me just start immediately. IFRS, basically, we all know. I don't need to explain a new thing to you about IFRS. There's no new thing I'm actually explaining to you. We've been using it in Nigeria for a couple of years. So I assume that we are all very conversant with the International Financial Reporting Standards. So it came to us a couple of years ago. So in 2010, it actually was September 2009 when the bill was signed for the Financial Reporting Council. So as a result of that, effectively, every company in Nigeria was being moved to IFRS, starting with the public interest entities and the PLCs. Then the other significant public interest entities went on in 2013. Then afterwards, we now add the SMEs in 2014. So effectively, everybody has gone IFRS. Now, what is the whole course around IFRS in itself? It's all about transparency. It's all about accountability. It's all about efficiency. Now, you discover the new set of financial statements you find after the transition to IFRS became very bulky. Why? Because you need to put some level of explanation as to what is inside what you have. For example, when you look at a financial statement and you find investment 100 billion. 100 billion investment might not directly mean that the company has cash of 100 billion. The investment might not even be readily marketable, meaning that nobody will buy such an investment. You have an investment, for example, you put some money into some investments that are not doing so well. You will discover that you still carry it in your books. The users of the financial statement will be under the assumption that it is a good investment. So, but under IFRS, you now need to begin to put information as to the credit risk on that investment. So you will discover that the financial statement is more bulky because there's more transparency, there's more reporting, there's more non-financial reporting explaining what is going on in the statement. And there's also more accountability. Why? Because as a result of the fact that the users of the financial statement all around the world, for example, I invest in a company in Ghana. Like we actually have a subsidiary in Ghana now. So I invest in a company in Ghana and I want to see their financial statement. And before now, what we used to have was that the financial statement from Ghana was different from what we always understood. But now, because everybody is speaking the same language, which is International Financial Reporting Standard, it reduces the gap. Why? Because now people that are reviewing the financial statement understand it enough. And not just understand it, there is more accountability because the people that you are giving it to understand what you are put inside the financial statement. Hence, you are giving them more level of account. You are showing them stewardship and they understand the stewardship. And the third thing around IFRS reporting is all about efficiency. Now, it helps users of the financial statement, investors, to identify opportunities, risk, and on within the financial statement. So it actually does so much around all of this when you see a normal IFRS financial statement. The sincere truth is that it is used in majorly almost all around the world, really. Many jurisdictions using IFRS already. So it's not a new thing, whether it's the full IFRS or it's the IFRS for SME. You find a lot of countries, profile jurisdictions that require IFRS is between 144 of 166 countries that was looked at. So effectively, everybody is around IFRS or using IFRS. For example, people used to say this one thing that, oh, but the US is not yet using it. Yes, the US is not yet using it, but there's what they call the convergence program. The convergence program has been going on for a while, really. And the sincere truth is that IFRS is actually looking more like the US GAAP. Rather than the US GAAP moving close to IFRS, IFRS is moving close to US GAAP. That's the sincere truth when you study some of those standards. Okay, so I think I will need to make some of them. So let's take it a step further. I'm not going to talk about whether it's full IFRS or IFRS for SME, it is IFRS. And I'll be explaining what the difference between them is. But I would just want to take it away from this comparison now. And just let's look at the full IFRS. So as I'm talking now, there are 17 applicable full IFRS standards. When I mean 17 IFRS standards. Now, when I mean IFRS, when I ask the question, are you IFRS compliant? I mean all of this. 17 IFRS standards, 28 IAS standards, 20 IFRS standards, 8 SIC standards, and 1 framework. So when I say, do you understand IFRS? I mean, do you understand all of this? When you say you are IFRS compliant, that means you have actually complied with all of these standards. Now, why is the naming convention different? So before the name was called International Accounting Standards Board, it was before International Accounting Standards Committee. When it was International Accounting Standards Committee, they were dishing out or writing standards that they call IAS. But when they changed their name to IASB, they started providing or initiating writing standards that are called IFRS. That does not invalidate applicable IAS standards. So IAS standards, you will discover that they are up to 41, but some of them have been replaced by newer IFRS standards. So you see all the IFRS standards, all the applicable IFRS standards and IAS standards are all IFRS. Then you now have the IFRS and the SICs. The IFRS and the SICs are explanations of the IFRS standards. So the IFRS standards are more process-driven. They are more guidelines. But you see, to explain the application of those standards in specific industries, explain the application of those standards in such a way that people will understand more. That is the essence of what they call interpretation committee. So the interpretation committee will give more understanding. And whenever they put those understanding, they put them out in what we call IFRS or SICs. The SICs are the interpretation for IAS standards that were existing before. The IFRS are the interpretation for the new IFRS standards that we have from IFRS 1 to 17. And we now have the framework. The framework is the foundation of all IFRS standards. The framework is like the building block, the pillar. What is in the framework? The framework has definition of things like assets, liabilities, conventions around which IFRS writes their standards, conventions around things like going concern, conventions around equity accounting, conventions around matching concept. They are the foundations, explanation of the foundation of the standard. That is what is in the framework. So all of this, when a question is asked, when companies prepare financial statement, they put a statement of compliance. They say, we have complied with all IFRS standards. It means that you have complied with all of this and more. That is what it means. Okay, so I think I got this. Yes, no problem. So let me go on straight. Now, all these are actually applicable IFRS standards. So when I mean IFRS, I mean all of this that applies to your company. If it doesn't apply to your company, don't disturb yourself. If, for example, IFRS 17 for insurance contracts, if you don't do insurance contracts, you don't need to know it. Sincerely, it is not like the old NASB where you just want to cram everything. Just know exactly what you need to know that applies to you. That is what matters really. And you also have all of these IAS standards that are still applicable. IAS 1 to IAS 41. Out of them, only 28 of them are still applicable. Every other one is not applicable any longer. Now, I just put all of that there. What are the benefits of using IFRS really? The sincere truth is that all over the world, the major benefit is the fact that there's transparency. I give you an instance. There are many things that happen, especially when there was a banking itch in Nigeria and some of those banks went under. It was all around reporting. It was all around transparency. One person actually house or is building a house, and that house or that building is their own in their name, and they borrowed money from the bank to do it and all that. If it were that there's proper transparent reporting where people put notes and disclosures to what they are doing, you wouldn't have found that. So one of the benefits is that there's more transparency because you would have to explain what you are doing. Number two, the fact that I pick a financial statement from the UK, a bank in the UK, and a financial statement from a bank in Ghana, and a financial statement from a bank in Canada. The three of them are prepared on the same guideline. And effectively, if I'm doing a comparison, it will be a valid comparison. Why? Because they are prepared using the same framework. So comparability with the rest of the world is another major one. And compliance with the regulators. Now, the sincere truth is that if you want to list on the Joburg market now, you don't need. So what we're doing then was that if a client wants to list on the Joburg market, you will bring the Nigerian financial statement, then we'll convert it to IFRS, then you go and list on the Joburg market. But now, with your financial statement the way it is, you can list anywhere. Whether on the Joburg market, whether it is on the UK market, anywhere you can actually list. And because of that, there's increased understandability, and people are able to get in even more foreign direct investment. For example, you hear of many companies in Nigeria getting in more foreign direct investment. Why? Because the users of whatever statements they would have supplied understands what they are saying. Yeah, rather than the one that we used to have, long-term investment and short-term investment, and people did not understand what it was. So, but the real thing is that there's still a lot of challenge. The number one challenge is expertise. And because this standard is quite dynamic, when I mean dynamic, it will change. It changed last year. It changed this year. It will change next year. It will continue changing. So there's nothing like, I knew it yesterday, I know it today. No, you continue knowing, you continue learning a new thing. There are standards that will change this year. There are standards that will change next year and continue to change that same way. And another major thing is also about data. I give you an instance. One of those standards that changed recently, IFRS 9, IFRS 16. The sincere truth is that companies are still finding it difficult to actually cope. You know why? It is very simple. It is all because it is not the same way it was before. There's a need to do a new thing, a need to get more data, a need to look at the systems that they actually have, whether it's churning out the right data. All this are actually some of the challenges that we actually find. But this morning, I'm just going to do two things really. Number one, explain to you the way a normal IFRS financial statement will look when you are reporting it and what you should look out for. And two, look at some more recent IFRS standards, and I will just drill down to the impact of the standards and what you need to learn to apply those standards. That is what I'm just going to do in this class, really. So let's start with how a normal financial statement in IFRS will look. A normal financial statement in IFRS could either be any of these two. It could be a statement of financial position, a statement of P&L and other comprehensive income, statement of changes in equity, statement of cash flows, and the notes to the accounts. But it is also possible that you break the P&L away from the other comprehensive income, and you now have it as statement of P&L is different and the statement of other comprehensive income different. Now, those are the two ways you will find it in any financial statement. However, there is a caveat because, for example, if you are looking at financial statement for a fund, I'm not talking about the company, the fund, like your pension fund, they use IAS 26. So their financial statement is a little bit different from this. But for normal financial statement, this is what you find. So the statement for a fund will probably look like statement of changes in equity and statement of equity. That's what you will find in your normal fund accounting. But this one is for normal accounts, normal financial statement. This is what you actually find. And the concepts are very simple. They are the same concepts you have always known. Every part of the financial statement is prepared using accrual basis of accounting. While Cash basis is what we actually use for statement of cash flows. All this you knew before, so I'm not disturbing you about it. But let's look at some major things. Some major things that there are presumptions or there are assertions that we are making. And there are some of those guidelines that actually we apply when we are preparing the financial statement. One major one is what they call substance over form. So the concept of substance over form is very simple. Now, the concept of substance over form is not what we are very used to. For accountants, for example, or auditors, they will always tell you, show me evidence. But you see, the evidence might be a paper saying it is fixed assets. But when you look at the substance of the contents of that transaction, you will discover that it's not PP&E. Yeah? You will discover that the substance of the transaction shows that it is not PP&E. So what am I saying in essence? What I'm saying in essence is that you need to look at the substance of every transaction, not the legal form. Let me give you a practical example that happened a while ago when I was doing a particular consulting for a company, I think in 2010. It happened 2009, 2010. The example, what happened was that there was, and I use this example almost every time, really, whenever I talk about this. There was a small company that was an haulage company. They move transportation company. And there was a bigger company that was into alcoholic and non-alcoholic beverages. So the smaller company and the bigger company had a contract. The contract is that the bigger company, which is the alcoholic and non-alcoholic company, was going to use all of the vehicles, articulated vehicles of the haulage company. Now, the haulage company, because they were going to be using all their vehicles for this big company, they decided to say, you know what, as we are leasing this company to you, are leasing all these vehicles to you, we also will want you to sign an agreement. And the agreement is that within the lease agreement, they said any agreement that they would have to make in the haulage company, because all their vehicles are being leased out to this bigger drink company, they said any decision they would have to make, the beverage company must approve it. If they don't approve it, they won't be able to move on. Number two, they also said that the COO, Chief Operating Officer of that company, will also come from the beverage company. Why were they doing this? They wanted to actually show that they are together with the bigger company. When you look at that example I just painted, it looks like a normal lease agreement. The name of the agreement where they signed all of these things was a lease agreement. But the sincere truth is that while it was considered under the concept of IFRS, it was discovered that there is a loss of control. So the people that signed the agreement, they thought it was just lease agreement. But when the thing was applied under IFRS, this bigger company has already taken control of the smaller company. Hence, the smaller company will be consolidated by the bigger company. So effectively, it was a sale of company, but the sale of the business was within a lease agreement. So if you were going to account for it, look using the legal form of the agreement, you would make it a lease. But you see, that thing was not a lease. It was business combination. It was that the bigger company was buying up the smaller company and it became a subsidiary. So when you are looking at one of the major framework around IFRS is substance over form. For every agreement, for every contract, you must look at the substance of the transaction, not the legal form, not the name they put on top of the agreement. You must look at what is the facts and circumstance inside the agreement, not the name they put on top of it. So that is one of the major things in the framework. Number two is also fair presentation and compliance with IFRS. The assumption of The assumption you are making when you are preparing a financial statement is that you have fairly stated all the things that you have in your statements. Now, I'm now asking you a question. So I was actually with one of these microfinance banks, one of their MD. So the guy actually told me, he said he wanted his net profit to be 500 million. He said he wanted it to be 500 million. So meaning that he's given a target that he doesn't want the P&L to drop down from 500 million. So the question is, can the preparers of the financial statement still be fair when management is telling them that the profit must not go below a particular figure? Can you still be fair? So if I ask you now, when you are preparing the financial statement, are you preparing it fairly? What would your answer be? What would your answer be? You can actually unmute, really. You are preparing it fairly.
No.
No.
Yeah.
So that means that you are not complying with this. Is that the meaning?
Exactly.
Okay. However, the assumption is that whenever you're actually preparing the financial statement, you are preparing it fairly. So you must actually maintain a balance, because the users of the financial statement are of the opinion that you have presented it fairly. Number two is the concept of going concern. The assumption is that you are preparing the financial statement with a notion that the company will continue as an operating company in the foreseeable future. What does that mean? It means in the next 12 months after the year end, you expect the company to continue. And that is the reason why we have things like payables and receivables. Why? Because you are saying this money will still come in. So if you are doing, we are on liquidation basis, you are saying that the company will not exist again. That at that point in time, you will not be using going concern. So when you are preparing a financial statement, you are preparing with the assumption that you will continue as a going concern subsequently after year end. Another major thing that we always do when we are preparing the financial statement, while we are doing that, is accrual basis of accounting. That is what we use. And what is the major thing with accrual basis of accounting? Is that income is earned. Not income is recorded when earned, not when collected. Expenses are recorded when incurred, not when paid. So when you are doing cash-based accounting, when you pay, you recognize. When you receive, you recognize. If you are doing accrual basis of accounting, income is earned. That is when you record it, not when you collect it. So for example, I sold a laptop to Mr. B. The moment I gave Mr. B the asset I'm selling to him, I have earned it because I've done my performance obligation. Whether he paid that day or not, I must recognize revenue. But if I'm doing cash base, I will not recognize revenue until I collect the money. So that is accrual basis of accounting. And another major thing that you actually also apply when you are preparing the financial statement is materiality and aggregation. So materiality and aggregation is, let me give you an instance. If there's no materiality and aggregation, all of your transactions, how will it look in the financial statement? Let's assume you list all of the transactions one by one. The financial statement will probably be like 200, 500 pages or 1,000 pages. So the essence of materiality is you only show material items on the face of the financial statement. Only material items, meaning that you group them together, you group similar items together, and you call them a particular name. Only the ones that are material are the ones that you will show. The other ones, you can aggregate them together and call them a name like other assets. They are assets, but you put them together and call them others, or other liabilities, or other expenses. That is aggregation. Yeah? And you put them together so that you don't have too many items on the face of the financial statement. Offsetting is a major thing too. For offsetting, the assumption is that do not offset IFRS actually frowns at offsetting, meaning show asset as assets, show liabilities as liabilities. You only can offset in particular area, when particular things apply, especially probably when you're looking at from the tax perspective. So those are just the little ways, really. So those are the basic things when you're actually preparing a normal financial statement. Some basic things you should consider. And remember, like I said before, when you are preparing a financial statement, major statements you are preparing, statement of financial position, it holds all the assets that you own. All the assets that you own, all the liabilities that you owe, and all the shareholders' funds that you use to actually finance the company. That is what you have in the statement of financial position. So right there you have assets, liabilities, and equity, all in your statement of financial position. Now, with the statement of financial position, you can actually do what they call order of liquidity, or you do current, non-current. Now, I want to ask now, since I'm speaking to the professionals, right? So tell me, what determines whether I use current, non-current, or I use order of liquidity? What determines it? I'm asking now, somebody needs to respond now. So what determines whether I use current, non-current, or whether I use order of liquidity? Oh, somebody needs to unmute so that you can answer. What determines it? How do I know whether I should use order of liquidity or current, non-current?
Hello?
Yes, you can go ahead.
I am Mr. Ojo Toluwase, FCA. I would like to say that it depends on the industry where the organization belongs. For instance, those in the financial industry normally show it based on order of liquidity.
Okay, thank you very much. You have just said it well. So it's a function of the nature of your business. And when I mean nature of business, is the nature and liquidity of your assets. Yeah, it is a function of the nature and the liquidity of, for example, in a bank or financial sector, what they buy and sell is money. I borrow you, I collect money from people, I give money out. It's money they buy and sell. So effectively, the nature of the asset you have is more money. If the nature of the asset you have is more liquid, then you use order of liquidity. If the nature of assets you have, that, for example, manufacturing, your major assets are equipment, PP&E is your baby, inventory is your baby. Because it's not liquid, then you use current, non-current. So it is the nature and the liquidity of your assets, the functions of those assets, and those liabilities. That is what determines what kind of, whether you do current, non-current, or order of liquidity. And put it in a simpler way, the industry. Yeah, because in a way, the industry has helped us to bring that together. But I will ask a major question. Now, what is current? What is non-current? Current is any asset will be current in a situation where we expect to realize it in the ordinary course of business within an operating cycle. And in most cases, we are holding it primarily for trading. We expect to realize our money back in 12 months. And in many cases, they are also cash and cash equivalents right inside current assets. Any other kind of asset is a non-current asset. So I expect to realize it in the operating cycle, in the ordinary course of business, is held for trading. I expect to realize it in 12 months. Money will come out of it in 12 months. That's the meaning. And it is cash and cash equivalent. Any other kind of asset is a non-current asset. Yeah? If that is the case, then let me ask a question. Also for a current liability and non-current liability. Let me ask a question now. Let's assume that we have a receivable. The receivable has been in our books since 2012. The receivable, however, at the end of this year, when we wanted to prepare financial statement, end of 2020, the people that were supposed to pay the same receivable, they said, oh, they will pay by January of 2021. Let's assume that this is 31 December 2020. Should that particular receivable be a current asset or a current liability? Sorry, a current asset or a non-current asset? Where should I put it?
Hello?
Yes, go ahead, please.
Yeah, this is Mr. Ojo again.
Yes.
I believe since there's that commitment on the part of the debtor to pay, it becomes non-current assets.
Non-current
For
asset.
those period that they fail to pay, once it
Yes.
is more than an accounting period, that's 12 calendar months, then it becomes non-current. But when they show the intention to pay by January 2021, it becomes current assets.
Okay. Any other thoughts? Thank you very much. Any other thoughts from anybody, please? Just unmute and give your suggestion. Hello. Any other thoughts from anybody?
Bogiano is my name. I share the same opinion with the last speaker, sir.
Okay. Thank you very much. Okay, so let us look at it together. It's almost like that. However, now mark me when I'm saying this. The number of years that asset has spent, that receivable has spent in receivable has no impact on whether it's current or non-current. What has an impact is, as at that year end, do you expect to realize it within 12 months? So for example, like in my example, I said the asset has been owed since 2012. So when we are preparing financial statement for 2013, the question will be, do we expect to realize this receivable in the next 12 months? If the answer is yes, it's current. 2014, if you ask the same question, even if the asset has been there since 2012, you need to ask yourself, do we expect to collect this money in the next 12 months? If the answer is yes, it will still be a current asset, even if it has been there since 2012. So the number of years it has spent in the past does not determine whether it's current or non-current. What determines is when you expect to realize it. Yeah, like I said, it is whether you realize it in the normal operating cycle, whether it's expected to be realized in the next 12 months from that point of assessment, which is your year end. Any questions? So that asset will not enter non-current at all. If it were that at every point in time when you are doing the assessment, you expect to realize it in 12 months at every point in time. Any questions on that? Yeah? Any questions on that? Can I go on?
I think it makes sense.
Okay. So that is current asset the same way. The flip side is the current liability. Just the same thing. Asset liability when you are owing. Yeah, that is the liability part of it. So, however, in the P&L, what we have is those things in the transactions that we are doing within a particular period. It shows the performance. So it actually has our inflows, outflows that we call revenue and expenses, cost, and all of that in there. Now, let me even ask a question before I go on. Let me ask a question. And the question is very simple. What's the difference between, so where do I put gains? Where do I put expenses? Where do I put losses? Where do I put other income? Where do I put each of those kind of items in the financial statement? Where do I put all of those kind of items in the financial statement? They are all going to be in my statement of P&L. But what are those items that enter P&L? And what are those items that enters other comprehensive income? What are those items that enters P&L? And what are those items that enter other comprehensive income? Please, can anybody help me with that? How do I know the items that are going to other comprehensive income?
Hello, am I recognized?
Yes, please go ahead.
Yeah, this is Mr. Ojo. I believe items that enters the P&L are those items that occur in the ordinary activities of the organization. That's the main crux of that establishing the business. While the other items that enter the comprehensive income are items that are the core business of that entity. I hope I'm clear.
Thank you very much. Any other thoughts? Okay. Thank you. Any other thoughts, please? What are those things that enter OCI? And what are those things that enter P&L? Any other thoughts? Okay, so let me put it this way. See, okay, let me even ask. So let's assume that I have other income. Where should I put it? Let's assume I have gains from investments that we are trading. Where should I put it? Because it's not in our ordinary. Remember those things. For example, just buy one investment and we put it there. Where should I put them? Should I put them in P&L or I should put them in OCI? Where should I put them? Where should I put them? I have an investment, and that investment, there's a fair value gain. Where should I put it? OCI or P&L? I sold some of the assets that are in the company. Where should I put the gain on disposal? OCI or P&L?
OCI.
Okay. Now, number one, let me just explain what you are correct with the fact that it is things in the ordinary course of business that we put in P&L. However, other income belongs to P&L. The things you have in OCI are your movements in reserves. Please, did you get what I just said? They are movements in reserves. What do I mean by movements in reserves? For example, when you do a revaluation of PP&E, that revaluation goes to revaluation surplus. If there's a movement in that revaluation surplus from year 1 to year 2, that movement will not go through P&L because everything that goes through P&L goes into retained earnings. So rather than it going through P&L, it will go through OCI. So what you have in OCI are movements in your reserves. Please, did you get what I just said? What goes through OCI or other comprehensive income are movements in reserves. So whether it is remeasurement gain or loss on actual on defined benefit obligation, whether it is movement in fair value through other OCI, all of those things are movements in reserves. Please, do you understand what I just said?
Yeah.
Yes, please.
Okay. They are only movements in reserve, nothing more than that. Okay. So I take a step further on this really, and I've explained a part of it. Then we have the statement of changes in equity. Statement of changes in equity is actually a movement account showing us what equity did we start with at the beginning of the year, what happened in all the equity. And remember, when I mean equity, I mean all the shareholders fund. That's capital, reserves, retained earnings, all the elements of equity. What was it at the beginning of the year? What is it at the end of the year? What are the movements in the middle? That is what a statement of changes in equity is. Yeah, so that is what that particular statement is. Now, when you are also preparing the financial statement, remember that you need to put information about the basis of preparation. For example, if you are preparing an IFRS financial statement, you must put a statement of compliance. We have complied with all applicable IFRS standards as issued by IASB. So you put the basis of that preparation. Beyond that, you also put, like I said, that all the information required by IFRS, including the statement of compliance, like I just said. You need to provide information to the users of the financial statement that will help them to understand and arrange the notes in such a way that people will understand, i.e., don't put note 1, then note 30, then note 2, then note 4 inside the statement of P&L, for example. So if you have note 1 as the first one, the second one will be note 2, third one. So you need to arrange it in such a way that the users of the financial statement will not be confused. Another thing is that you need to actually arrange. The standard does not tell you should arrange it in a particular way. It only suggests the way you should actually arrange those, but it doesn't tell you must arrange it that same way. Beyond all this, you need to put the name of the users, or sorry, the name of the issuer of the financial statement or the reporting entity, the level of rounding. You need to put the presentation currency so that people will not get confused. You also need to actually state whether it is a consolidated financial statement or just a financial. For example, Adiola and Co financial statement of P&L, or it is consolidated Adiola financial statement. So you need to show whether it's group or it is just a single company. Any questions on that The standard that covers preparation or presentation of financial statement is IAS 1. So I just talked about what IAS 1 requires without having to mention the standard. So that is that. Any questions on that before I move on? Any questions on that before I move on?
I think we're enjoying you.
Spaces, sir.
Okay. Okay. So let me go a step. I just want to look at two particular standards that are quite new, that people are still struggling with and companies are struggling with. So I will explain it, probably not in too much detail so that you don't get bored, but as much so that you can actually get some level of information. Now, let's talk about IFRS 9 a little bit. Now, when you actually have a financial instrument could either be an asset or a liability. It can either be you own it or you are owing somebody. Now, when you are initially recognizing it, you recognize it at fair value plus minus transaction cost for those ones that are classified as fair value through OCI and amortized cost. So let me try to actually type something. So let me go and open Excel so that basically this will be better understood. Yeah, let me try to open one blank new Excel sheet. So I mean, at initial recognition, for financial assets, and for financial liabilities. So for financial assets, we have three classes. We have the first one, it is called fair value through P&L. It is called fair value through OCI. It is called amortized cost. So those are the three major classifications for financial assets. For financial liabilities, we only have, so we have this one for financial assets. For financial liabilities, we only have this one and this one. There's nothing called, for financial liabilities, there's nothing called fair value through OCI. I want to believe that is understood, are we? So these are the kinds that we have. So at initial recognition, how do we recognize? At initial recognition, for all of those ones as fair value through P&L, we recognize only the fair value alone. However, for those ones that are actually either amortized cost or fair value through OCI, we recognize at fair value plus minus transaction cost. Let me put that in more understanding in a real life situation. So all this is the way we recognize this. Now, let's assume that we are investing in FGM bond. And the amount for the bond is 200,000. Let's assume that. And let us also assume that we will pay a particular person, a particular commission before we can buy it. And let us assume the commission is 1,000 naira. Now, this bond can be classified as fair value through P&L. Can you hear me?
Oh, it went off, but it went off just now.
The line is breaking.
Okay, but can you hear me very well now?
Yes,
Okay,
you are on now.
Yes.
Okay.
You may likely go over the explanation, sir.
No problem. I'll go over it immediately. So I said, let's assume that I have FGM bond. We paid 200,000 naira, then there's a commission of 1,000 naira to be paid. Now, if we are classifying this bond as fair value through P&L, it's only this 200 that we will classify. The other 100,000 naira, we will expense it. Please, did you get what I just said?
Yes.
Now, if it is fair value through P&L, but in a situation where it is amortized cost of fair value through OCI, the amount we are going to initially recognize is the addition of the two, which is with the commission. Please, do you understand what I just said? We will not expense anything. We will capitalize everything. If it is fair value through OCI or amortized cost. Any questions? Please, did we get that?
Yes.
Yes.
Okay.
We
So
seem
that
to
is-
be. Hello, sir. I think amortized cost is the one we are used to, and now the only capitalizing the initial amount is a little bit new.
Yes, I know that is IFRS now. That is why I'm actually explaining a little as much as I can.
Come over here, sir.
Yeah. Okay, sir. So let's now assume. Let me even make it as more practicable as possible. Now, when you are buying, say for example, an FGM bond, this thing I put here, you know that you will have face value. Let's say the face value of this bond is 200,000, 1, 2, 3, but you are buying it at a discounted price. So we have a discount price, and the discount price is 10,000. The discounted price is 190,000. Now, the difference between these two is your discount. The fair value of this investment is 190,000, not 200,000. Please, did you get what I just said?
Yes.
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 So the fair value, if it were that this one is just this same example that I put here, the amount you will recognize on day one will not be 200,000. It would have been the 190,000 plus the 1,000 naira, 191,000. So the question is now, how would you account for this? Now, the way we used to do it before, under NGAP. Now, I'm now telling you that at initial recognition, what you should have recognized would have been, let me put debit and credit here. I said you will recognize bond. In this example, if it is amortized cost, I said you will recognize bond to be equal to 191. I now said that then you will recognize bank, meaning you are paying money. How much are you paying? The total 191, because you paid 1,000 naira to the person that the commission, and you pay 190,000 to the. So this is what you would have recognized. But the way we were doing it before, what you would have done, which is wrong now, is that you would have come here and now say the amount you will do here is how much? 200,000. Am I correct? Then you will now say, oh, the amount you are paying now is only 190,000. Am I right?
191.
Or 191, if you put that inside. Then you will now say you have unearned, Abi? Yeah. Interest income. Is that not what you do?
Of 10,000.
Then you now say that one is the difference between this one and this one. It is wrong. Please, this thing is wrong. This one is wrong. This one is the correct thing. Any question? So this is the way you should do it. Now, what will now happen in the amortized cost computation? Please watch. Now, I now need to do what they call amortized cost computation. So I come here and I do period. I do opening balance. I do interest, income, and I do repayment, and I do closing balance. Now, let's assume that this thing, this investment, it is the coupon. You know, you pay coupon rate. Let's assume that the coupon rate is 10%, and the bond is for tenor, is for 5 years. Let's assume this. Now, my period here then will start from period 0. So if I scroll down to period 5, that will be for the whole period, the 5 years. Opening balance using what I've accounted for here is 191. Yeah? Closing balance is always equal to opening balance plus interest minus this repayment. Then opening balance is this, and I drag down this understanding. Yeah? Repayment. Remember, when you are actually taking this kind of instrument, repayment is done, let's say annually. And how much is the repayment? Is the coupon times the face value. So I'm making this absolute so that when I drag it down, it will not move. However, at the end of the life, they will give you your principal back. Am I correct?
Yeah.
Yeah, so I add the principal, which is the face value. That is the way it will be. Now, what do I now need to calculate? Now, under the standard, they talk about something called effective interest rate. The contract rate here is 10%. So that means I have to calculate an effective interest rate, which is not given anywhere. So how do I calculate that? Now, watch what I'm doing. I say equals to interest income is opening balance times what should have been inside this effective interest rate. I don't know it yet. So I come here and I make this absolute. And I drag down this till the end. Now watch what I'll do. And in simple Excel, I go to what if analysis, I click on goal seek, and I say set this cell to become 0. Why? At the end of the life of this instrument, government will not owe me, I will not owe government, so it will be 0. By changing what? By changing what will be inside EIR, and I say, okay, Excel will calculate it for me. Can you see that this thing is correct now? Hello? Hello?
Yes, sir.
Okay, can you see that everything has fallen into place? Now, this thing is telling me that the effective interest rate is not actually 10%. The effective interest rate is 11.4%. Yeah, and these are the interest income, not the repayment of 20,000. So when I'm going to pass the entry for year 1, when they pay us, the entry will now be, so I come here, I add debit, and I have credit. So when they are paying us, when we are, remember, interest income is when earned, not when collected. So even if they have not paid us this repayment, we will account for this one. At the end of the year, whether they pay us or not, we will account for this one. So we'll come here and we'll say interest income. How much is the interest income? Credit this amount, which is our interest income, and come here to the bond, the FGM bond, come and debit it with that. And also, the second one is repayment. When they pay us, we come and we say bank. Bank will be debit of this amount, and the credit is going to the bond account, which is the amount here. Now, at the end of this first year, so that you will know that this thing is correct, remember, I started with how much at the beginning? 191 in the bond account. Am I right?
Yes.
Now,
yes,
remember that in the bond account, there's additional debit of 21, and there's a reduction in the bond of a credit of 20,000. Can you see that this amount is exactly the same amount that is inside this schedule? Can you see that? So at the end of the life of the instrument, it will become 0. So this is what you will be using to pass the accounting entries. And that is what IFRS 9 requires. Any questions? Can I proceed? Okay. Should I go on? Okay.
Please do, sir.
Hello, sir.
Okay. Yes, I'm listening to it.
Okay, sir. If we at times, if the interest rate is reviewed either upward or downward within that period of 5 years, how can we now adjust for that?
So let's use exactly, they call it catching up adjustment. So let's assume that at the end of the first year, just watch, at the end of the first year, they now review the interest rate to 15%. That's your question, am I correct? So that means that the coupon is no longer going to be this amount. Please watch what I will do. That means that this coupon that we are paying, it will not be a gain. So this particular amount that I have here, this amount here, I just come here and I'm going to make it copy and paste special. Please watch what I'm doing. Now, they changed the rate here in this new year. So that means that this particular one will no longer be times 10%, it will be times 15%. Yeah, so that means that the amount that will be paid, that they will be paying us will now be 30,000. Then at the end, they will pay us 30,000 plus the face value. Yeah, I think they typed it in the wrong place. They will now pay us 30,000 plus the face value. Yeah, so this is what will happen. So please watch what I'll do. I will now come here into this place and say, set this cell. I'll just come to data and say, what if goal seek? Set this cell to 0 by changing what the opening amount would have been. And I say, okay, Excel will calculate it. Now, if you look at this, it is now a different amount. Am I correct? 223. The difference between this one and this one is what they call a catching up adjustment. So this one minus this one. You see this catching up adjustment, you now need to pass it like this. You now say bond. Bond will no longer be 191 that we close to it. It would have increased by this 30,000. And where is the credit going to go to? The credit will go to interest income. And that is the way you pass a catching up adjustment. It will, if you can look at it, the effective interest rate has not changed. The only thing that changed is the opening balance. And I passed it through into interest income. Any questions? Madam, I have the question. I've answered a question. I've answered your question.
Yes, sir. I said I'm okay that you can go ahead, sir.
Okay, that means, okay. So that is what you actually do for financial instruments. Now, like I said, there are also classes of financial assets is amortized cost, fair value through OCI, and fair value through P&L. And it is a function of two models, business model and cash flow model. Don't worry, in this class, I might not go into too much detail so that I don't bore you. If you want to actually attend the full class, there's no, but really in this class, I don't want to bore you too much. Yeah, so that is, now this also impairment is the major one under IFRS 9. Is a critical one. Impairment is using what they call the expected credit loss model. And the expected credit loss model does not look at whether the loss has incurred or has been incurred. It looks at the loss that could come to play in the future. Yeah, so for example, you take a 5-year loan. When you are calculating impairment, you are looking at the probability that the person will default tomorrow, next year, next 2 years, next 3 years, next 4 years, and next 5 years. While you are, and now those things have not happened yet. So you might need to actually do some extrapolation to know what that probability will be. Under IFRS 9.2, you also have stage 1, stage 2, stage 3 impairment that you actually do for all of this. So I think at this point, because I think I'm supposed to do a 1-hour class, any questions at all on anything that we have done? Any questions at all on anything we have done? Any questions? Okay, Musa Rahim is trying to join in back. Any questions? Any questions? Okay. So that is actually what is majorly inside IFRS 9. So you have stage 1, stage 2. Remember, also for interest revenue, the moment you're on stage 1 or stage 2, yes, we can be calculating interest income on gross. The moment you're on stage 3, you calculate it on net, no longer on gross that you used to calculate it really. IFRS 16 is on leases. And for IFRS 16, the first question is, what is a lease? A lease will only be those ones that you have right to obtain substantially all the economic benefits from the use of the assets, and two, you can direct what goes on with that asset. Those are the ones that are under. Okay, so you asked for practical demonstration on how to calculate this here. Okay, now, so let me show you a little example. So how do you calculate ECL? Very simple. ECL, expected credit loss, is equals to probability weighted credit loss. Equation 1. Credit loss is equals to present value of cash shortfalls. Equation 2. So what is cash shortfalls? Cash shortfalls is equals to the difference between contractual cash flow and expected cash flow. Equation 3. Now that is the way you calculate this. Now, let me paint this with this example. Let's assume contractual cash flow on an instrument and expected cash flow. Contractual cash flow is based on the terms of the agreement. For example, you are supposed to be paying 100, you took a loan of 100,000. Yeah, and you're supposed to be paying 10,000, or a loan of 50,000. You are supposed to be paying 10,000 or 12,000 every year. Let's assume. So that means for the next 5 years, you are supposed to be paying this. This is year 1 to year 5. Let's now assume that after you took the loan, something happened, which now necessitated that you now told your banking officer that, you see, this first year is possible you might not be able to pay the money. That, you see, give them some time. By next year or next 2 years, we will clear everything. So expected cash flow ends is that in year 1, you can't pay anything. In year 2, you will pay the full money. Let's now assume now told them, you know, in year 3, you might not be able to pay. I'm still muted. Hello, can you hear me now?
You are on, sir.
Okay. Yes, I can hear you.
Okay. So this is, if you look at this, you will think that there's no difference. But look at this. What I call, like I said, CCF minus ECF is cash shortfall. So this is cash shortfall. Cash shortfall is the difference between contractual cash flow and expected cash flow. That means in year 1, there's a cash shortfall. In year 2, the remaining years. So there's a cash shortfall here. There's a cash shortfall. There's no cash shortfall here. There's no cash shortfalls on these ones. Now, you might think that is the same thing, everything give us 0, but that is not the truth of the matter. Because 12,000 naira next year is not the same thing as 12,000 naira today. Neither is it the same thing as 12,000 naira in the next 5 years. So that is where we now say credit loss is PV of the cash shortfalls. So to calculate credit loss, this credit loss now, credit loss, we need to look at what is the effective interest rate on the loan at the beginning. Let's assume it is 10%. If it is 10%, then credit loss is equals to NPV of the rate for all of the cash flows, that all the cash shortfalls. This thing is telling me that the credit loss is 3,532. That's the credit loss. Then the ECL is now the probability weighted weight of this credit loss. What is the probability that these things that this person said will come to pass? To calculate that, we use what they call the probability of default. To calculate probability of default is another baby that I will suggest you attend a full class is another baby that if I start calculating, it might take a while. You can actually calculate it from a credit scorecard. Yeah. So let's assume the probability of default for this one is, say, for example, 50%. Yeah. A very simple, however, the standard requires that we also bring in scenarios. But I will not talk too much about that one. So that means ECL will be 50% times the credit loss. So the impairment you are going to have is 1,766. Any questions? Any questions? I don't know whether this internet has gone again, so you need to say yes or no.
Yes, you can go ahead, sir.
Okay, no problem. So that is the way you also, for the person that asked about the calculation of impairment, that's the way you calculate it. Okay, so just summarize or to conclude on this particular very short and free class, very short class, because this is not a full class really. I'm not doing a full class really. So IFRS 16, okay, somebody is asking a question, so let me read. This will need full lecture. Yeah, okay, because I've actually explained to you the way you can. Don't worry, you can actually just join the, I don't know when the full class will be, but they will send you probably when the full class for that particular thing will be, so that you can join. It's actually a 3-day class. So it's not a 1 hour class like this one. This one is a 1 hour class. So IFRS 16 is all about leases. The major thing with this lease one that we have now is that whether you are, there's nothing like finance lease and an operating lease from the perspective of the lessee. From the perspective of the lessee, lease is lease. And you will create two particular things whenever you are taking a lease. You will create what they call right of use asset and also what they call lease liability. But from the lessor, you can have an operating lease or a finance lease. And the way you also account for it is also different from what we actually have. Now, I would like to actually bring it to a close here. If you have any questions, please, you can actually ask at this point. I will also advise that you join the full class. This I was supposed to actually do an hour class, so I think I've already done more than 1 hour. So, any questions? The video will be made available to you. These slides too will be made available to you. They are all free. There's no, yeah. And they will probably also send you a link to the full class for each of this. Any questions for me? Any questions for me, please?
No question from my own end.
Okay.
Just to appreciate you, sir.
Okay, thank you very much. Okay.
You are welcome.
So I'd like to bring at this point in time, thank you. Like I said, my name is Shewa Kinyelu, and this is GODP bringing you this very short class. I want to believe you have learned something. Have you learned anything in summary? Did you learn anything?
A lot, sir.
Yes.
Very educative presentation. Thank you, sir.
Wonderful. So thank you very much. They will send you the slides. They will also send you the video, a link to the video so that you can actually watch it afterwards. And they will also send you probably a link to the full class so that you can join us for the full class. Thank you very much. I appreciate you. And I'd like to say bye-bye at this point. Is there anything you would like to say before? Okay, thank you very much.
My name is Bogi Stevendele, the chairman of Ijebu District Society. I would like to thank you on behalf of other members of the district for a wonderful job done. We really appreciate you, sir. I would like to get in touch again with you in the nearest future. Thank you so much.
No problem, sir. No problem. Thank you very much. We appreciate you, and we would like to say thank you and have a lovely afternoon. Yeah.
And you too. Thank you.
You're welcome, sir.
You're welcome, sir. Okay, bye.